Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, Russia's Black Tuesday. The ruble fell, interest rates were hiked in response, and the ruble fell further. An economy already in decline takes a massive hit. So just what will Vladimir Putin do next? And we'll look at what the Russian fallout means for the rest of the world, including oil prices and Middle East markets. Also this week, the staple of Macau's economy, gambling. But there might be a bit of financial roulette round the corner, maybe a losing streak as takings start to slip. And what a lack of roads does to food prices. We're in a remote corner of Nepal where it's easier to travel to Tibet. Many think that's where their economic future lies. So, picture this. It's the start of another cold Russian winter. The ruble is falling. Economic prospects are as bleak as the forecast. And so in the middle of the night, 1 a.m. Moscow time, the central bank makes a desperate move. OK, perhaps there's a little artistic license there, but that is essentially what happened. Interest rates were raised from 10.5% to 17%, but even that didn't work. The Russian currency's now lost more than 50% of its value, which will lead to a crippling rise in the cost of imports. Finally, it seems Western sanctions have made their point. Vladimir Putin won't get away with his annexation of Crimea and interference in Ukraine. But this is a heavy penalty for the Russian people to pay. Many have taken out mortgages in US dollars. With the ruble's fall, their repayments have doubled. In all the chaos, gas giant Gazprom slipped out a statement saying it would fire up to 25% of its workforce. Just remember, Gazprom employs in excess of 500,000 people. But there could be an international price to pay as well, a heavy one. Russian corporations have taken on debt from Western institutions. It's estimated these Russian companies need to repay $650 billion, and given they're shut out of international markets right now, they can't refinance their debt. It's often been mentioned that Vladimir Putin would use the default of loans as some way to punish the West. But this story goes beyond currency. It's about oil, natural gas, it's about other global markets. And we're going to attempt to thread all that together for you this week. In a moment, Rory Challens looks at why Russians have rushed to the shops as the currency tanks. But first, after the interest rate hike failed to work, Russia began to actually spend billions of dollars from its sizable reserve fund to try to stabilize the currency. Patricia Sabka from Al Jazeera America finds out now how much of its rainy day fund it can actually deploy.
$414 billion. The reserve fund that's kept Russia's painful ruble rout from becoming a 1998-style debt default after a dramatic interest rate hike failed to beat back speculators. And with Russian President Vladimir Putin Thursday assuring his economically ravaged nation that a rebound is at most 2 years away, it begs the question, how long can Russia's rainy day fund hold out?
You can run the math with any number of assumptions, and with all of them, it doesn't last forever.
Russia has taken a $100 billion bite out of its reserves in the last year, blowing the lion's share of that, some $80 billion, on defending the ruble. And not all of the $414 billion that's left is easily tapped. $45 billion of Russia's reserves are held in gold, while another $12 billion is tied up with the IMF, mostly in non-cash instruments. Russia also counts $172 billion in its sovereign wealth funds as reserves, including the National Wealth Fund, which is meant to cover an expected shortfall in state pensions.
It's not absolutely clear how liquid the assets in that fund are, so probably they should be discounted a bit.
Deduct these potentially illiquid items, and Russia's cushion doesn't look nearly as plump. Sobering, given the price of its main export, oil, could fall further, and firms targeted by sanctions can't refinance tens of billions of dollars worth of debt coming due next year. Hiking interest rates and buying up rubles with foreign reserves isn't the only way to prop up the currency. Russia could take steps to limit the flow of foreign capital in and out of the country. A drastic measure that would spare its rainy day fund, but expose just how little control it has over its exchange rate.
An upmarket showroom selling expensive German cars doesn't seem an obvious winner with the economy tanking. But these are strange times in Russia, and Audi is happy to be doing brisk business.
Россияне решили сделать себе прекрасный подарок к Новому году.
The math is simple. In spring you could buy one car for $50,000. Now you can buy two for the same money.
Now, even if I wanted to buy this car, I can't because it's sold. So is this one, so is this one. Pretty much everything in this showroom has recently been sold. Now, it may seem counterintuitive in the middle of a financial crisis to go shopping, but there is logic to this spree.
The logic is this. The distributor imported and priced these cars at an exchange rate that bears no connection to current realities. When new stock is imported, it will be bought with a ruble that's collapsed in value, and consumer prices will rocket. Sergei is buying a TV to take advantage of a situation he knows won't last.
It depends on what people planned to buy before but decided not to wait any further. We don't expect the situation to get better soon.
And that's the thing. This is a bonanza with a fatalistic edge. Russia's economy is in deep trouble, and people know they will soon feel the pain.
One should not allow things like this to happen. They should not allow people to speculate on the ruble. Of course it influences ordinary people. I don't like this situation.
Some retailers seem paralysed, not knowing what prices they should be charging. Apple has closed its Russian online store. Rory Challens, Al Jazeera, Moscow.
So it looks bad, doesn't it? We're going to try to get a handle now on just how bad it is and could be with our guest, Nicholas Spiro, who's joining us from London. He's the Managing Director of Risk Analysts, Spiro Sovereign Strategy. Thank you for your time, Nicholas. Let me read you something that Vladimir Putin said. He talked about the West trying to chain up the Russian bear and strip him of his teeth and claws. The guy just doesn't back down, does he?
No, and I think this is a very salutary reminder, not that one was actually needed, that it's clear that those who actually believe that the more severe Russia's financial crisis is going to get, the more likely it is that Vladimir Putin is going to adopt a more conciliatory tone, have to fundamentally revisit their assumptions. It's clear that he is digging in his heels, and in fact, he's actually emboldened by this economic crisis because he genuinely believes that it is essentially external factors which are responsible for the ruble's collapse.
But
and to a certain
flip
extent,
side of that, Nicholas, sorry to interrupt you. On the flip side of that, as all this was happening, he was apparently on the phone to Angela Merkel and Francois Hollande and Poroshenko. All these people sort of. If he's smart, he'll be thinking about an exit strategy as well, because these problems aren't just things that will go away quickly.
No, they aren't, and I think that certainly the Russia's economic and financial woes have clearly upped the stakes significantly. But it's very important to actually see what's at stake. Ukraine is the most serious threat to Russia's dominance of the post-Soviet space since the end of the Cold War, and Vladimir Putin is not going to let Ukraine go. Belarus was a sideshow relative to the Ukraine. There's an awful lot at stake as far as Russia is concerned, much more at stake than there is for the West. And it's clear that for the time being, he believes that he can ride this crisis out. The fact that we've seen a firming of the ruble over the last 48 hours, and I would just stress a firming. It's still roughly a fifth down against the dollar since the beginning of this month, will certainly add to the perception on the part of Mr. Putin that volatility is the watchword, and that he can more or less ride this out, given Russia's large foreign exchange reserves, and given the fact that he is clearly determined to batten down the hatches and do whatever it takes, so to speak.
Okay, let's widen it out and look, because you talked about who gets affected. You were mentioning Ukraine and the like. I want to get an idea of other countries that can be affected by Russia's problem. We profiled a while ago on this show the fact that Germany has a lot of business interests there. You've got the former Russian satellite countries and all these things. I mean, they're going to have to watch this one closely as well.
Well, this has been the case for the last several months or so, ever since the toughening of the West's sanctions regime against Russia. It's been clear that business confidence in Germany has taken a real hit. I think the surprising thing is how resilient the Central European economies have actually been, particularly Poland. And I think that we've already seen that the resolve among the West to face down Russia is starting to crumble. France is already saying, as we saw at yesterday's EU summit, that it may be time to start to scale back some of the sanctions. There's very little appetite within the West to really start to even go further and actually toughen up the sanctions regime further. And Mr. Putin is clearly playing on this.
And then there's the thing you can't control, essentially, and that is the oil price. This is the other factor which has, been such a concern, I guess, for Russia and for a lot of other markets in this past week. That seems to be something which the Russians and everyone would just have to get used to for a while, because they're not going to bounce back to the crazy high levels again.
Until we get a floor for oil, we're not going to get a floor for the ruble. The overriding factor shaping sentiment towards Russia, and not only Russia, but all of these oil exporting nations, is clearly oil. Is the price of oil. This is the overriding factor. The sanctions clearly are exacerbating the economic weakness. But trying to conduct monetary policy amid the carnage caused by the fall in oil prices is something of a kamikaze mission. And that's why the credibility of Russia's central bank has been severely undermined. They've thrown everything but the kitchen sink at the ruble, and all to no avail, virtually.
Might have to pick up the kitchen sink then. Nicholas Spiro, thank you so much for your time today. Do appreciate it.
Thank you.
So as we said there, the falling oil price is a big factor here, and it goes beyond Russia. Yes, OPEC members have said they can live with lower oil prices, but the impact on stock markets has been pretty devastating. In the last 3 months, look at these ones: Saudi Arabia, Dubai and Qatar. They have entered into what we call a bear market territory. That is stocks which are down more than 20%. Dubai, the real standout there, in two ways, because it was the world's biggest performing market this year and is now down 40%. Well, joining me via Skype from Houston, Texas this week is Ghassan Jahayeb. He is the Chief Investment Officer of Dubai-based Sancta Capital Group. Ghassan, Middle East, especially Gulf markets, can actually be volatile beasts anyway. Is this just more of that, or are we seeing some sort of major correction here, do you think?
Kamal, this is the result of a lot of speculative excess that's run up over the last 12 months, really. And then there was essentially a trigger that caused it all to crack, and that was oil prices retracting. But essentially, the markets will stay volatile for quite some time, in my opinion. There's still a lot of margin in the system. UAE-based investors and the whole, a lot of the volumes in the system are based on retail investors. So, the big difference between a lot of the Middle Eastern markets and the U.S. markets is that the Middle Eastern markets are very retail-driven, and that's definitely the case in the UAE, for example, where about 90% of volumes are driven by retail, sentiment-driven, emotional investors who can really throw stocks, like a baby out of the bathwater in very bad times and into very deeply undervalued levels, and then move them up into bubble territory and in times of optimism as well.
And what do you make of the idea that the UAE reckons it can live with $40 a barrel oil. That doesn't, I mean, it seems a big call, put it that way.
They can do it, but only for a finite amount of time, maybe 3-4 years at the most. But certainly they won't. They don't intend to do it for that long. I think this is just their strategy of rationalizing global production and supply in the markets, and there's probably some serious geopolitical intentions behind it as well. And the intent is to, I think, maintain that, keep the taps on for at least 6 to 12 months to rationalize supply and achieve these geopolitical objectives. And then policy will be kind of revisited at that time between mostly the GCC members. But yes, certainly, I mean, the UAE has over $700 billion worth of sovereign wealth and FX reserves. Same with Saudi Arabia. Kuwait has significant amounts as well. So they can ride out the storm for a significant amount of time if need be. And this is definitely a rainy day, and that's what they prepared their coffers for. So, these guys are intent, I think, on maintaining supply the way they have and the way they announced in late November until they rationalize supply in the market and they achieve the objectives.
We focus mainly on the UAE, but this has been a regional thing. I was interested to see that the Egyptian market actually, I mean, that got hammered. Obviously, Egypt is in the natural gas game more than oil, but does this just show you how nervous investors are, that the Egyptian market can get hit as well over the oil price?
Certainly. I think, there's a few reasons behind that, Kamal. First of all, Egypt, does not have a currency that's pegged to the dollar like the GCC states. And given that, investors are seeking a flight to safety into U.S. dollar-denominated currencies, any market that is denominated in a non-pegged currency like that is going to get shaken up. Secondly, Egypt has depended significantly on the GCC states for funding over the last, year or so since Sisi has come into power, and that's over $20 billion worth of aid. And this is coming from very oil-rich nations that have just seen the price of oil get cut in half. So there's reasons, for investors to be concerned about maybe potential future support to Egypt. I think it will be unwavering for a good amount of time. However, that's definitely sent jitters into the market. And third of all, we are in a time, just more generally and stepping back, of very, very heightened geopolitical tensions and also an emerging markets currency crisis. We're having currencies across Africa, Latin America, Eastern Europe that are collapsing at this point in time, and people are getting very, very nervous. So EM is a very hated asset class at this point in time.
So if you're a Middle Eastern investor right now, what do you do? Do you just have to ride this out? My first observation to you is that these are volatile markets anyway. Do you just have to ride it out again, or is this a major correction to adjust to if oil is going to go down and stay down this low?
It is our team's opinion that this is a temporary low in oil and that the market will rationalize itself. Supply and demand will reach equilibrium eventually. There's supply glut in the market, and that will fix itself eventually, and that is the intent. OPEC does not intend to act as a swing producer again and wants the market to naturally balance out. What's taken oil from $115 to slightly under 60 recently also has to do with a lot of financial speculators. And I think that these guys are getting margin calls and pushing down the market as well. So the point is that towards the second half of next year, our base case is that oil will stabilize and start to clear anywhere between $65 to $80 again. And that is bullish for any investor in the GCC and also Egypt. There's a lot of great companies that are trading at very attractive valuations right now, and there's still some that are still trading at expensive valuations. So we've seen quite a correction, but some markets are now just at fair value while others are looking attractive. But one thing to note again is that there was a big run-up that was fueled by a lot of speculation, investors pumping up things on margin, a lot of IPOs that shouldn't have been bought up that were. So we're now seeing a natural correction of that.
Ghassan Chahayeb, a pleasure talking to you on Counting the Cost. Thanks for joining us. Now, here's an interesting problem. A place essentially built on gambling, which now has a gambling problem. Only this problem is not enough gamblers. Macau has seen its takings fall for 5 successive months, apparently due to fewer big rollers coming in from mainland China. Rob McBride takes up the story now.
It is the school that trains the people who keep the casinos running. In Macau, casino work is just about the only game in town, so the industry's losing streak has everyone alarmed.
There are very few alternatives for local people. Macau needs to be more diversified, or it will face tremendous risk.
The Macau government has been trying to diversify the economy away from its reliance on gambling. Still, the casinos account for 80% of its revenue, business which in turn is heavily reliant upon China, allowing the steady stream of gamblers across the border. Morning at the border crossing, there is no shortage of day trippers from mainland China. What's lacking are the so-called high rollers. China's crackdown on corruption means it's not wise to be seen flaunting huge amounts of cash, and the big money has been staying away.
They don't want to be implicated, in that case they rather not coming, and then especially those who are really, we call it the big shots, the high rollers.
It has made the casino industry review its expansion plans here, paradoxically a move welcomed by many casino workers. Dealers have been protesting about wages that can't keep pace with inflated property prices in the overheating economy. And for dealers like Leong Manteng, the predicted doubling of casinos in the next few years had filled him with dread.
It is extremely hard for local people to maintain their living standards. The slowdown will give Macau time to adjust instead of being dominated by the gaming industry.
A former Portuguese colony that had a reputation as a sleepy backwater before the casinos arrived, Macau can pause for a moment to remember what that was like. Rob McBride, Al Jazeera, Macau.
And now the story of a remote mountain district in the Himalayas called Humla, which finds itself at a fork in the road. The people there face extraordinary inflation on food prices because of poor infrastructure and access. But access from where? Nepal, which has made promises to fix the situation, or Tibet, where the people believe their recovery lies? That story now from Sabina Shrestha.
There is little to choose from this shop in Sinikot in the northwestern Nepal, and what can be found is as much as 5 times more expensive than the capital Kathmandu. A kilogram of sugar in Kathmandu is around 80 cents. Here it's $2.50.
For every kilogram we pay an extra 130 rupees.
Humla and neighbouring Dolpa are the only 2 districts in Nepal disconnected from the rest of the country. Nepalis here are some of the poorest, and yet they pay some of the highest prices.
Humla is being connected by a road not to the rest of Nepal but to Tibet in China. When this road is completed, it'll take only 4 hours to reach Tibet. Some people here say that this is a road to prosperity for this district.
Apple farmer Padam Lama has been planning for the day the road link is complete.
If we set up a shop in Tibet, you can get up to $6 a kilogram. I started this farm, but without roads. I'm bearing all the loss.
Apples, herbs, nuts and vegetables are just some of the products this area has to offer. But it's been 17 years since Hilsa-Simikot Road started construction. Locals say that Nepal's government was not keen on this road, as it preferred to connect the district to the rest of Nepal and not to Tibet.
No, we faced a lot of problems in the past, but now I should praise the government. Now they are allocating budget right now. They have told that by next year they will complete Hilsa-Simikot Motor Road. If the government had given interest in the past, we could have already joined that road from Tibetan border to at least up to Jazeera.
Tibet might be the nearest market for Humla, but besides roads, trade agreements with China will have to be carved out. Building materials, including fuel for this Hilsa-Simikot road, has been acquired in Nepal, driven hundreds of kilometers across Tibet to be brought back to Nepal. Locals here say that roads and a favourable trade treaty with China could change the lives of all those living in districts bordering China. Sabina Shrestha, Al Jazeera, Humla, northwestern Nepal.
And that is our show for this week, but there's more for you online at aljazeera.com/programs. The Counting the Cost page is there with individual reports, links and entire episodes for you to catch up on. As well as down the right-hand side, you'll see the social media feed. People's comments and feedback is there. You can join that by tweeting either me at Kamal AJE. There's also our business editor at Abid Oliver Ali, and do use the hashtag Counting the Cost as well to get on that social media feed, or go old-fashioned on us. Send us an email. countingthecost@aljazeera.net is the address. But that is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.